Have you ever heard a story like this? Someone puts $5,000 into a futures trading account, and a few days later, not only is the entire $5,000 gone, they suddenly owe their broker $40,000. It sounds impossible. It sounds illegal. But this happens in fully regulated markets using financial products listed on the Chicago Mercantile Exchange. And the crazy part? Futures were never designed for speculation. They were created as a safety mechanism, a way for farmers, airlines, and business owners to protect themselves from price swings. So how did a risk management tool turn into a debt machine for retail traders? Today, we break down what futures were actually designed for, how leverage turns tiny bets into massive losses, why most retail traders lose, and why futures only make sense for a very specific kind of player. Nothing here is financial advice. This is risk education. 1. Futures were born as insurance, not a casino. Imagine a small bakery owner in the US. Flour prices have been stable for years. They have a healthy margin. Life is simple. Then the headlines start. War disrupting grain supply. Drought in wheat-producing states. Global food inflation. If wheat prices double, that bakery collapses. So what does the owner do? In the early commodity markets, farmers and buyers came up with a simple idea. Let's agree on a price today for a transaction we'll make in the future. The farmer protects their income. The bakery protects its costs. That's it. That's the original purpose of futures. Lock in a future price, so real businesses don't go bankrupt. Fast forward to today, and this structure lives on in wheat futures, oil futures, natural gas futures, S&P 500 index futures, gold, silver, currencies, and more. Every one of them started as a shock absorber, not a get-rich-quick tool. 2. Then the speculators arrived. Now picture a completely different type of person. No farm, no bakery, no airline. Just a trader with a laptop. They're not here to receive wheat or barrels of oil. They're here for one thing: price movement. If they think oil is going up, they buy futures. If they think the S&P is going down, they short futures. They never want the real asset. They only want the price difference. That idea, I can profit whether markets go up or down, is extremely seductive. But it hides something dangerous. 3. The hidden trap. Leverage. Here's where futures turn deadly for retail traders. If you want to buy $100,000 of stock, you normally need close to $100,000. But a futures contract might only require a 5 to 10% margin deposit, meaning with $5,000, you can control $100,000 worth of exposure. That's 20 times leverage. A 1% move in your favor, you make 20%. A 1% move against you, you lose 20%. A 5% move against you, your entire account is gone. And markets aren't gentle. They spike. They crash. They gap overnight. On volatile days, a 10 to 20% movement in commodities or crypto is normal. With leverage, that is enough to blow past your entire account and start generating debt. This is how someone's $5,000 turns into a $40,000 bill. 4. Margin calls. The broker doesn't wait. When the market moves against you, your broker watches every tick. If your account value falls below maintenance margin, you get a margin call. Deposit more money now, or we will liquidate your position. Most beginners react the same way. It'll rebound. I just need more time. So they add money. Meanwhile, the market continues falling. If they don't add enough money fast enough, the broker force closes the position at whatever price is available, often at the worst moment of the day. That's how traders end up with their account wiped out and a negative balance they are legally required to pay. 5. Who you're actually competing against. Let's talk about the opponents in the futures market. You're not playing against casual hobby traders. You're trading against hedge funds with teams of analysts, algorithmic high-frequency trading firms, global commodity houses, market-making desks at major banks. They have real-time data feeds, risk engines, automated execution, decades of historical modeling. Futures are close to zero sum. Your profit is someone else's loss. And historically, the overwhelming majority of retail futures traders lose money over time. Not because they're stupid, but because the structure of the market is unforgiving. 6. The only time futures make sense. Futures are powerful tools when they're used for the purpose they were designed for, hedging. They make sense when you already have real-world exposure. For example, airlines lock in jet fuel costs, farmers hedge crop prices, exporters, importers hedge currency risk, large investors adjust portfolio exposure. They're not betting, they're stabilizing their business. For them, futures are a seatbelt. For retail traders chasing quick profits, they become a loaded weapon. 7. If you still feel tempted, if you're still thinking, I'll be different, I'll be disciplined, understand this. Almost everyone who blew up in futures believed exactly the same thing. If you still want to go near futures, never use rent money, emergency funds, or debt. Use minimal leverage, predetermine stop-loss levels, practice long before scaling up. Treat survival as the first goal. But even then, there are far easier ways to build long-term wealth than competing with institutions in a leveraged, zero-sum arena. 8. The final takeaway. Futures are not inherently good or bad. They're tools. Used correctly to hedge risk and protect a business, they're invaluable. Used recklessly, as a shortcut to fast profits, they can destroy your finances faster than almost any other financial product. So the next time you see gold futures rising, oil futures crashing, Bitcoin futures volume exploding, remember, behind those numbers are real companies protecting themselves and countless retail traders learning an expensive lesson. Because the truth is simple. Futures are powerful. Futures are useful. And for most retail traders, futures are far more dangerous than they look.